My name's Ethan Braid. Today we're going to look at actual results for the 4% inflation-adjusted retirement spending rule, and we're going to use the Fidelity Balanced Fund as our retirement investment. We're going to look at these results over the last 24 plus years and then see how did this rule fare over that time period. Let's quickly go over what the Fidelity Balanced Fund is, and then we'll move on to our 4% retirement spending rule illustration results. The Fidelity Balanced Fund is categorized as a moderate allocation mutual fund. It has an expense ratio of 0.51%. The fund is highly diversified. You see that there are 5,157 holdings in this fund, and it has a dividend yield over the last 12 months of 1.64%. The fund is balanced. 62% is in the stock market and 38% is in the bond market. The fund has over 70% of the stock market exposure in large and giant cap stocks. The fund is heavily tilted towards large cap growth with over 41%. You see that there are some mid cap and small cap stocks in the fund. The fund is 95% in the United States, with a small amount international. The fund's top holdings are Microsoft, Apple, Amazon, Nvidia, Google, Meta. The bond exposure of the fund is 26% corporate, 37% government, 32% securitized. The securitized would be mortgage bonds and things like that. The bond maturities in the fund are 3% short-term, 51% intermediate, and 45% long-term. Now let's dig into the 4% rule illustration results. In this illustration, we're investing $1 million on January 1 of the year 2000. We will distribute $40,000, 4% in the first year, and then grow that distribution by 3% for inflation every single year of the illustration. What's really encouraging to see is that despite the fact that there were not one, but two recessions in the first 13 years of this illustration, and I'm talking about 2001 recession and then the 2008 recession, using the 4% rule, inflation adjusted over the last 24 plus years, and using the Fidelity Balanced Fund as your retirement investment resulted in growth of your capital so that you ended with $2.1 million after this 24 plus year period. Pretty exciting to see these numbers that I'm going to get to here in just a minute. We're going to look at a table of the numbers on a year-by-year basis. I think these results are very encouraging. If you were 65 years old in the year 2000, you would be 89 years old today with more than double the capital that you had when you retired, and all of your spending needs had been met over the last 24 plus years. So this is great data to see. Now let's move on and take a look at the actual data table to see a little bit more refined numbers. Here's our $1 million investment going in on January 1, 2000. And you can see in the first year, we're taking out $40,000, 4%. And then every year thereafter, we're growing our distribution by 3% for inflation. This total reinvest column right here are the dividends, capital gains, coupon payments from bond, interest from T-bills, etc., that the fund is earning. This total reinvest column is the actual income of the fund. And what you'll notice that it is somewhat erratic, and that's because we do have some years with big capital gains distributions, like 2007, you see this 103,000. That's where Fidelity was making adjustments in the fund, and they distributed a large capital gain that year. Also in the year 2000, that's why you have 61,881 in total reinvest column, and then it drops down to 40. But overall, Fidelity did a great job here, in my opinion. If you look at how they managed risk in the downturn of 2000, 2001, 2002, 3, etc., you don't see a lot of losses here. So Fidelity did an outstanding job at managing risk as we moved through this recession in 2001. Very important thing to think about Not all funds did as well as this Fidelity fund. I've done other illustrations with the Vanguard Balanced Index Fund, for example, where they didn't do quite as good of a job as Fidelity. So being able to manage risk in a recession is really important to your long-term success when you're retired. These results are encouraging to see, given the fact that the illustration starts right before the 2001 recession and a 13-year bear market. We went sideways from 2000 to 2013. If you are retired and you're watching this video, this graph will be very important to you. Most retirees will see at least one bear market during their retirement. I've identified bear markets here as the red arrows. These are periods where the stock market has no return for price appreciation for a long period of time. We can see the Great Depression here, 25 years, then the 60s and 70s to the early 80s, and then the early 2000s. When you're doing your retirement planning, it's really important that you have an investment strategy that will hold up during a bear market and likely recessions. It's easy during the bull markets. When we have green arrows and everything's going up, anybody can make money and you don't have to worry about your distributions nearly as much. But when we enter a bear market, everything changes and preserving your capital becomes a priority. Knowing where you're at in the business cycle is a really important part of retirement planning, in my opinion. We have been in an incredible bull market for over a decade. The next bear market may not be that far away. All of the signs indicating a recession could be around the corner are right in front of us in 2024. So you want to be prepared for that and make sure your investment strategy can withstand a bear market, in particular your spending strategy. One thing that you can do as a retiree to improve your odds of success with your retirement plan is, to the extent possible, lower your distribution, decrease your spending if you find yourself in a bear market. If you're watching your portfolio value drop, try to back off on your spending, even a little bit. It will make a huge difference in the long-term success of your retirement plan. Yes, this Fidelity Balanced Fund was a great investment over the last 24 plus years. Coupled with the 4% inflation adjusted spending rule, it worked really, really well. But we don't know what's going to happen in the future. So again, if you can back off on your distribution when, not if, but when we're in the next recession and bear market, it will really help improve your retirement plan. I hope this video was helpful. I hope this video gets you thinking about your situation, helps you better analyze your investments, and overall improve your family's financial plan.